Long gone are the days of China being the world's factory, and their downfall has been a long time coming. With a declining population, a crashed economy, tense geopolitical relations, and riots raging across the country, it seems like President Xi Jinping couldn't have asked for a more horrible start to his third term in power. Let's find out more. Turning tables. Through massive government expenditure, China was able to navigate through the huge recession that affected much of the world in 2008 to 2009 and support the global economy. Doesn't look like they can be lucky this time round. A repetition of a Chinese-led recovery is less likely now. We're all inching closer to entering a global recession due to Russia's conflict in Ukraine and 3 years of the COVID-19 pandemic. In 2022, China's GDP barely grew by 3%. According to a survey of 37 economists conducted by Nikkei in December, growth is expected to fall in the first quarter of 2023. And not even the most upbeat recovery forecast for China indicates a return to the explosive growth rates that the nation had become accustomed to for years. Since Beijing began implementing economic reforms in 1978, China's GDP has increased by an average of around 10% yearly. Since the pandemic first started, the second largest economy in the world experienced many ups and downs. Repeated crackdowns on the private sector and tight zero-COVID lockdowns have destabilized supply chains and eroded investor confidence after an early optimism about the economy's recovery in 2020. To make things worse, the country's population fell last year for the first time in 60 years, generating unsettling concerns about its future labor force. Can China ever hope to return to sustained high growth now that President Xi Jinping has essentially cemented his position as the country's leader for the foreseeable future and the nation has officially exited zero COVID? Do you want the long answer or the short answer? Because the short answer is no. And that's according to economists and analysts who believe that China's period of double-digit growth is gone. The level of growth that they're able to maintain in the next few years will depend on Beijing's ability to respond to the structural issues that face its economy and the effects of Xi's new goals. It's not looking too good so far. The nosedive. Data from the World Bank shows that until 2021, China's economy expanded more than tenfold, from $1.2 trillion to over $18 trillion, thanks to years of rapid GDP growth. But economists predict that during the next few years, China's growth rate will decline to between 2 and 5%. Even that hides a shift that's already taken place. Focusing simply on GDP data runs the danger of missing the bigger picture because they only provide a fragmented, inaccurate view of the Chinese economy. Get this. According to the stats, the high-growth era appears to be coming to an end now. But in terms of productive investment, it ended around 10 to 15 years ago. When it comes to catching anomalies brought on by China's soft budget constraints, which points to a model where the state steps in to cover for spending that exceeds the income gained from a project, GDP, which was originally developed to gauge Western economies, is not designed for the job. In China, if it's politically required, you can keep losing money indefinitely, but it doesn't accurately reflect the economy's fundamental capability for production. A majority of economists seem to agree that China's previous economic model has peaked and nosedived. The country's economy is going through a significant shift right now, so the future is uncertain to say the least. The curse of the aging population. China's recent record-breaking growth was fueled by exceptional demographic and economic circumstances, but those circumstances have already vanished. As China's population ages quickly, the large labor pools that supported its low-cost industrial base are getting smaller. In 2022, the population of the nation began to drop after several years of slower birth rates. This year, India will surpass China in terms of population, while multinational corporations continue to relocate more production to countries in Asia, including Vietnam, Malaysia, India, and Bangladesh. The debt-fueled infrastructure and real estate developments that have historically fueled China's growth have also reached their peak, but the returns on these investments have been declining. Total factor productivity, which measures how much output an economy actually produces as a percentage of inputs, is no longer increasing as quickly in China as it once did. Back in 2008, productivity growth was averaging 2.8%, but since then, it has fallen to barely 0.7% annually. As shown by the collapse of the largest real estate developer in the nation, Evergrande, in 2021, this has left numerous heavily leveraged businesses and municipal governments on the verge of collapse. There are certainly certain levers China's authority may pull to lessen the blow. They may implement a policy similar to Japan's, which raised the official retirement age for both men and women to 65 in order to boost the labor force participation rate. Even then, the crisis might only be somewhat postponed. After reaching a peak of just under 1 billion people in 2015, China's population in the 15 to 64 age range is already declining. Getting rid of the hukou system, which links social benefits to household registration, might boost urbanization levels and support China's labor force. The current system often denies state benefits like public education to migrant workers in cities, acting as a barrier to increased urbanization. Yup, that all needs to change if they want to get better. The man at the top. Beijing's policy priorities under Xi have evolved away from the motto of growth at all costs that was followed by previous post-reform administrations. He has instead placed a focus on high-quality growth, which is a guiding principle in China's current 5-year plan. It's a part of Xi's new development concept, which places an emphasis on China's economic equality and resistance to external pressure. In essence, experts believe that the plan is to create a domestic, consumption-driven economy to diminish China's reliance on export-driven growth. A strong domestic market can serve as a shock absorber for sanctions from the West and a fragile international trading system. Aside from pursuing cutting-edge technologies like quantum computing and improved semiconductors, China's new plan intends to lessen the country's carbon imprint. The need for domestic development of these technologies has increased as a result of a wave of strict export control measures implemented by the US. But can high-quality growth provide the old runaway growth rates? It hasn't happened historically. It's theoretically possible though. Doesn't hurt to try, does it? Here, consumption is the biggest key. By the end of 2021, household spending as a percentage of total GDP was around 38%. Far lower than the global average of 63%, making China one of the major economies with the lowest levels of consumption. Unless there's a surge in that, they can kiss their economy goodbye. What this means for China. Though not equally, the weakening of China's growth engine will affect everyone. Many countries will feel the decline in demand, especially those who have come to rely on China as their primary export market. The winners and losers during this shift will be mainly determined by how quickly they can switch to other faster-growing emerging markets, such those in Southeast Asia and India. The geopolitical power balance will also be impacted by the slowdown. If China's economy reaches its peak in the next 10 years, it'll be less likely that it will overtake the US as the world's superpower. Experts have cautioned that such a scenario could push Beijing to move more rashly on issues it sees as its core interests, such as Taiwan-related tensions. It goes without saying, but analysts foresee unrest in China as well. The watchword of the Mao era, common prosperity, has been adopted by Xi as a guiding economic philosophy, shifting Beijing's attention to correcting inequities, including those in housing, healthcare, and education. But in reality, it's evolved into the talking point for intrusive market intervention. For example, soon after a crackdown that reduced their company's combined market worth by over $1 trillion, China's tech CEOs gave billions to the cause, or were they forced to? Also, those zero-COVID policies were a crucial factor contributing to further eroding China's long-standing dominance of global trade. In these months, China lost more manufacturing and export market share to Asian neighbors than ever before. They've lost a huge chunk of exports across a range of industries, including minerals and office technology. China has also lost ground in important consumer categories like apparel and accessories, footwear, furniture, and travel items. Well, it's all about survival of the fittest, and it looks like China has run out of luck. What do you think is the biggest reason behind China's downfall? Let us know in the comments below. Make sure to watch the next video for more.